The global silver market has experienced remarkable price volatility throughout the year 2026. Investors must look beyond short-term price fluctuations to understand the underlying structural shifts taking place. Silver is transforming from a simple monetary asset into a highly critical industrial resource in the modern world. Historically, people valued this precious metal primarily for wealth preservation and beautiful jewelry. However, the modern macroeconomic landscape and rapid technological advancements have pushed these two identities into a powerful convergence. This fundamental transformation transcends its historical status as a mere satellite to the traditional gold market for modern investors. Prices surged significantly before experiencing dramatic market corrections early in the year. Market participants must focus carefully on the underlying mechanisms of supply inelasticity and the accelerating requirements of the global energy transition. The current market regime is defined by persistent structural deficits alongside extreme price volatility moving forward today. Industrial applications now account for approximately 60% of total annual demand globally. This substantial figure continues to rise steadily as the world builds out immense solar capacity and transitions completely to electric mobility. Unlike gold, the utility of silver is firmly grounded in its unique fundamental physics and chemistry. At the molecular level, its single-valence electron configuration enables the absolute highest electrical conductivity of any element. This total irreplaceability makes it the industrial backbone of modern electrification efforts globally. Performance margins in these advanced sectors determine the ultimate success or failure of newly developed green energy technologies today. The most significant demand shift over the past decade is the rapid emergence of solar energy applications. The solar industry share of industrial demand has nearly tripled, reaching 29% recently. This explosive growth stems from a steady transition toward higher efficiency cells, requiring significantly more conductive precious metals. Next-generation solar panels require specialized conductive paste for electrical contacts on both sides to achieve higher efficiency ratings. While older technology consumes about 10 milligrams per cell, newer designs can require over 20 milligrams. Global solar capacity could quadruple, creating massive ongoing consumption requirements for the metal going forward. Automotive electrification represents the second crucial pillar of industrial growth, currently transforming the global precious metals market today. Electric vehicles utilize roughly double the specific amount of silver compared to conventional internal combustion engine vehicles. The metal supports extensive battery management systems, power electronics, and vital high-voltage electrical cabling. The rapid rise of autonomous driving technology adds a third massive layer of robust demand within the modern automotive sector. These complex navigation systems rely heavily on advanced radar arrays and precision cameras for passenger safety. All these vital hardware components depend entirely on superior conductivity for high-speed processing. A rapidly accelerating structural driver is the specialized hardware infrastructure required for artificial intelligence and expanding global digital networks. The massive physical build-out of hyperscale data centers requires significant amounts of conductive material for server electronics. A single massive computing facility can require up to 25 kilograms of silver. The global fifth-generation wireless network rollout adds a strong structural floor to overall telecommunications electronics manufacturing demand trends. Base stations require roughly 11 grams of conductive material, compared to significantly lower historical amounts previously used. The telecommunications sector alone will consume many millions of ounces during the deployment period. Despite this explosive industrial demand growth, the global supply side remains fundamentally disconnected from current pricing market signals today. Approximately 70 to 80% of global production is merely a secondary byproduct of mining for base metals. Massive increases in commodity value do not necessarily lead to corresponding production increases. The global market is currently facing its sixth consecutive annual supply deficit, forcing participants to aggressively draw down vault inventories. This massive structural shortfall, where total industrial consumption deeply exceeds total available mining supply, has persisted continually. The persistent production deficit adds tremendous pressure to an already remarkably tight marketplace. Global primary mine production has remained largely stagnant for a full decade, hovering near 800 million ounces produced annually. While several new operational projects are being commissioned, they remain insufficient to fully close the massive widening gap. Industrial recycling provides some additional ounces, but consistently suffers from low recovery. To navigate this complex financial environment, investors must carefully monitor the macroeconomic engine largely driven by real global interest rates. The precious metal becomes significantly more attractive to buyers when real yields remain continuously suppressed or fall. Elevated inflation expectations also drive robust institutional demand for tangible physical hard assets. The ongoing currency relationship with the United States dollar remains a highly critical factor for tactical portfolio positioning and overall strategy. Since the physical commodity is globally denominated in dollars, a weakening currency makes the metal substantially more affordable. This dynamic clearly stimulates international buying interest, particularly in consuming nations. For informed investors looking to perfectly time their market exposure, the traditional ratio comparing both monetary metals provides reliable data. The mathematical ratio measures exactly how many silver ounces are required to purchase one single ounce of gold. Historically, this important metric has averaged around 60 to 70, historically speaking. When the monitored ratio reaches extreme upper statistical levels, it typically signals that the white metal is significantly undervalued historically. During periods of severe financial panic, gold vastly outperforms as a primary safe haven, while industrial commodity demand contracts. This divergence reliably pushes the calculation to historic highs, creating opportunities. Conversely, in precious metal bull markets and broad economic expansions, the higher volatility and industrial strength cause massive silver outperformance. This compresses the relative valuation heavily toward lower numerical levels, suggesting that investors should rotate their profits appropriately. The rapid compression reflects explosive market surges driven by unrelenting technological consumption. Choosing exactly how to play the volatile price requires selecting a specific vehicle, perfectly aligning with individual risk tolerance levels. Physical bullion bars represent the ultimate unshakable foundation of wealth preservation by eliminating complex counterparty financial risks completely. It serves as tangible crisis insurance during severe systemic banking emergencies globally. However, physical metal ownership undeniably comes with high upfront purchase premiums and challenging storage logistics that cautious investors must navigate. For many practical individuals, holding tangible heavy bars becomes truly cost-effective compared to other paper options only eventually. Investors must carefully weigh these security benefits against the associated costs. Exchange-traded funds offer instant market liquidity and exceptionally low transaction costs for active participants wanting tactical trading advantages daily. These specific paper instruments track spot prices perfectly without requiring owners to handle any complex logistical delivery nightmares personally. Institutional traders vastly prefer physically backed trusts because they limit risks. Mining company stocks introduce operational financial leverage into the broader investment equation, providing exponential profit margin expansion possibilities during rallies. When spot market prices rise comfortably above base sustaining costs, the underlying corporate margins increase dramatically, creating shareholder returns. This specific leverage mechanism, unfortunately, operates bidirectionally, punishing weak companies severely. These dedicated extraction producers face relentless cost inflation pressures from rising energy expenses and skilled labor shortages that compress margins. Geopolitical jurisdictional risks also constantly plague primary extraction sites located in developing nations with varying levels of regulatory stability. Unforeseen permitting bureaucratic delays or severe environmental disasters can devastate valuations. Specialized streaming and royalty companies provide massive upfront capital to active mining operations in exchange for discounted future production rights. This highly lucrative financial model provides excellent underlying commodity upside, while brilliantly avoiding the direct operational risks completely. They typically enjoy massive overall profit margins and maintain thoroughly diverse portfolios. To survive incredibly volatile precious market environments, retail investors must employ a strictly disciplined tactical framework without succumbing to emotions. Dollar cost averaging remains the absolute preferred strategy for building positions steadily by investing fixed monetary amounts at regular intervals. This incredibly consistent approach automatically lowers the average purchase price. Averaging effectively removes the immense psychological emotional pressure of trying to time unpredictable markets perfectly during parabolic rapid upward surges. Active tactical asset allocation involves making carefully calculated adjustments to broader portfolio weightings based on clear macroeconomic technical indicators. Maintaining long-term physical core holdings ensures lasting generational financial stability. Given extreme daily price movements, stop losses must be set significantly wider than those traditionally used for standard equities. Standard tight percentage rules often trigger premature panic selling during completely normal daily market fluctuations, ultimately harming performance. Professional commodity traders utilize advanced true range metrics to allow necessary breathing room. The bullish investment case faces legitimate long-term structural risks, primarily regarding industrial substitution capabilities. Thrifting involves deliberately reducing the precious metal content within manufactured goods to combat exceptionally high input material costs. Historically, the material accounted for a completely negligible tiny portion of total solar, photovoltaic manufacturing expenses globally. Today, constantly rising prices have severely elevated basic manufacturing costs, forcing leading technology developers to fiercely prioritize alternative metallization techniques. Innovative copper electroplating processes aim to completely eliminate reliance on expensive precious materials in mass production. However, these promising substitution methods currently require massive initial capital investments, hindering rapid adoption. Macroeconomic monetary policy reversals also pose substantial severe downside risks to current spot market valuations going forward. Persistent high inflation could force central banks to maintain aggressively tight monetary policies, suppressing demand for non-yielding assets. Furthermore, deep global recessions generally slash industrial consumption, deeply potentially outweighing safe haven buying. Despite these highly valid risks, the broad banking analyst consensus regarding the long-term trajectory remains exceptionally bullish overall today. Major financial institutions project prices reaching unprecedented new baseline levels as green infrastructure development accelerates continuously. The massive structural market deficits suggest robust valuations are nearly inevitable moving forward confidently. These massive physical deficits persistently indicate that triple-digit valuations are totally inevitable as above-ground stockpiles become utterly exhausted soon. Successfully navigating this highly volatile commodity requires a profound psychological shift among individual retail market participants today. Speculators must stop treating market fluctuations as dangerous, unpredictable external portfolio threats. Investors must confidently view these violent temporary pullbacks as highly strategic accumulation allocation opportunities instead of pure panic events. Dramatic spot price corrections constantly create genuinely excellent entry points for those fully comprehending the underlying economic supply realities. Maintaining a solid physical foundation offers unparalleled portfolio protection against unforeseen collapses. Physical bullion securely serves as a reliable portfolio ballast, preserving critical intergenerational wealth, effectively entirely outside traditional fiat currency networks. A modest, balanced physical allocation perfectly anchors aggressive speculative equity bets with tangible decentralized value preservation during crises. Traders prioritizing high-margin mining equities must carefully scrutinize detailed corporate documents. Favoring established large senior producers with extremely low sustaining operational costs drastically maximizes profit expansion potential while mitigating inherent hazards. Selecting premier structured royalty companies firmly delivers superior equity-style financial leverage, without unnecessarily absorbing direct underground operational risks. The fundamental industrial utility of this essential material is rapidly expanding. The global industrial utility of this conductive element is rapidly reaching an unprecedented historic peak across international manufacturing markets everywhere. Its traditional historic identity has evolved far beyond being just a simple monetary safe haven for deeply worried conservative investors. Modern technological progress absolutely mandates increasing metal consumption completely continuously. Understanding the unique interplay between fragile macroeconomic sentiment and intense industrial consumption allows for optimal defensive portfolio construction strategies today. Sudden short-term price corrections should not shake disciplined individuals possessing a solid firm grasp of essential market fundamentals. The long-term structural macro bull case remains incredibly compelling fundamentally. Broad investment demand remains incredibly strong as widespread economic uncertainty persistently drives capital into proven safe haven physical hard assets. Wealth preservation strategic strategies increasingly incorporate precious metals to hedge against devastating inflationary economic threats effectively worldwide. Rising global sovereign debt levels force large institutions to seek better viable alternatives. Institutions aggressively seek robust alternatives to rapidly depreciating fiat currencies across completely interconnected international financial networks during turbulent, uncertain times. Several dominant central banks have actively recognized the profound importance of diversifying their massive national reserve asset holdings carefully. Major sovereign wealth funds continue accumulating heavy bullion to balance portfolios. These massive institutional buying patterns drastically alter the fundamental baseline supply and overall demand balance, driving sustained upward valuation momentum. China has forcefully implemented new strict industrial export controls, prioritizing growing domestic technological requirements over international market supply availability. This significant policy change severely restricts refined bulk metal exports immediately. Restricting exports adds additional severe strain to highly vulnerable global green manufacturing supply networks operating everywhere today. Rising geopolitical friction undeniably accelerates broader supply chain fragmentation, creating totally isolated regional inventory imbalances and massive pricing discrepancies. The United States formally recognized the profound strategic importance of maintaining adequate domestic reserves. Designating this physical asset as a highly critical protected mineral highlights its completely irreplaceable essential role in national security and modern technological infrastructure. Governments increasingly treat this rare resource as absolutely vital infrastructure, transforming the overall industrial demand equation, completely moving forward definitively. Conductive paste costs create massive margin compression. These extreme pressures force top-tier solar module manufacturers competing globally today to adapt quickly. Surging industrial commodity prices force relentless innovation, pushing desperate engineers to furiously test alternative complex metallization technologies immediately. Despite these urgent efforts, commercializing completely new conductive printing techniques demands massive prohibitive capital financial outlays continually. Heavy capital constraints frequently hinder rapid widespread industry implementation across global manufacturing markets. Junior mining exploration companies present incredibly asymmetric upside speculative opportunities due to major recent advancements in modern digital geological exploration methodologies. Modern satellite detection tools significantly reduce initial field prospecting costs and greatly compress lengthy development timelines. Investors safely targeting these highly innovative agile juniors must explicitly accept much higher baseline equity volatility while anticipating massive future discovery financial rewards carefully. Proper portfolio diversification across pure unhedged producers and robust reliable base metal miners ensures reliable baseline stability across wildly fluctuating unpredictable market economic cycles moving forward. Strictly assessing detailed environmental compliance and broad sustainability initiatives remains absolutely essential for securing long-term institutional investor capital attraction currently. Top-performing mining operators consistently demonstrate extremely strict operational capital discipline, alongside rapidly expanding robust underground resource bases. Evaluating fundamental extraction production costs provides vital portfolio downside asset protection. Evaluating these crucial metrics thoroughly during severe sudden commodity price plunges saves investors tremendous capital. Lower baseline operating expenses allow premium competitive companies to easily maintain robust dividend yields and properly fund aggressive new exploration programs sustainably. Regional geopolitical stability remains a top crucial risk factor influencing overall asset valuations. Regional stability heavily dictates overall future mining production predictability, deeply impacting profitability. Understanding the totally unique financial transmission mechanisms distinguishing passive exchange-traded funds from active operational mining equities prevents catastrophic unbalanced portfolio mismatches. Physical tracking funds faithfully trace spot prices, closely successfully capturing pure unadulterated fundamental physical asset appreciation. Funds capture pure appreciation entirely without absorbing complex underlying business execution, hazards inherently found elsewhere. Equities tightly pool varying corporate risks demanding deep comprehensive fundamental analysis, far beyond making simple basic metal price trajectory assumptions. Many respected professional analysts confidently aggressively forecast future triple-digit pricing targets, eventually arriving globally. Analysts confidently project much higher valuations given the unrelenting structural global supply and industrial demand imbalances everywhere. While professional predictions vary widely regarding exact timeframe timing, the fundamental underlying physical market physics clearly point toward a severely constrained future. Above-ground physical reserves cannot permanently satisfy voracious growing industrial appetites. These reserves cannot satisfy the voracious huge appetite of rapidly expanding modern green energy technological manufacturing sectors perpetually. Strategic portfolio allocations should intelligently combine core physical holdings with high-quality streaming companies to perfectly balance downside protection and upside leverage. This intelligent dual strategy captures exponential explosive upside during rallies. This strategy beautifully maintains solid defensive characteristics during terrible, unexpected, severe global economic recessions. A thoroughly well-structured portfolio deeply respects both the ancient traditional monetary heritage and the modern industrial destiny of this incredibly vital element. Volatility simply represents an inherent, deeply rooted feature of everyday precious metals pricing. Pricing volatility consistently provides uniquely lucrative entry points for smart investors displaying cold emotional discipline continuously. Sudden exceptionally severe pricing corrections generally follow massive unwarranted speculative retail spikes, shaking out highly leveraged amateur traders rapidly. Surviving these utterly brutal market swings requires steadfast, unshakable conviction in the underlying structural crisis. This underlying supply crisis propelling long-term values remains absolutely undeniable. The massive rapid transition from older legacy photovoltaic technology fundamentally altered overall raw material consumption rates forever across the entire global manufacturing industry. Modern advanced cell architectures demand significantly thicker conductive metallization layers to properly achieve impressive performance metrics. This single massive technological shift guarantees highly elevated baseline raw demand from the booming renewable energy sector for many coming decades. Secondary physical recycling volumes remain profoundly inadequate for effectively closing the rapidly mounting annual structural supply deficits plaguing global commodities markets. Complex electronic component disassembly challenges ruin recovery totally. Terrible overall recovery rates from broken old discarded solar panels severely hinder robust secondary market supply growth. The modern global market remains incredibly structurally dependent on totally stagnant primary underground mining output to somehow satisfy rapidly expanding green consumption needs. Consumer silverware and basic jewelry recycling volumes generally peak occasionally. These volumes only surge higher when newly established record-high commodity spot prices adequately motivate normal everyday consumers to liquidate items. This highly unpredictable, remarkably price-sensitive scrap source simply cannot provide a truly reliable steady stream of fresh new material during lengthy market consolidations. Consequently, above-ground bullion depletes. Above-ground stored commercial inventories face continuous steady depletion, strongly pressuring available daily physical liquidity at all major global commodity exchanges. Trading exchange-registered physical inventories have plummeted quite dramatically, highlighting the genuinely severe physical structural shortage reality currently confronting modern institutional investors everywhere. Extremely low vault safety levels matter. This extraordinary global market transformation creates completely compelling, unprecedented generational wealth-building opportunities unseen in previous commodities cycles throughout modern financial history. The highly coveted white metal has decisively absolutely proven its totally unique, irreplaceable fundamental value, powering the emerging green economy and firmly protecting personal wealth simultaneously forever today.